Investors returned from a long holiday weekend to a sell-off. Stocks tumbled on, ironically, some upbeat economic data because that fueled expectations a rate hike from the Federal Reserve could come sooner rather than later. Add grease to the mix, and it all adds up to the worst decline for the blue-chip Dow index this month. The Dow Jones Industrial Average fell 190 points to close at 18,041. NASDAQ was off by 56, and the S&P 500 finished 21 points lower. Dominic Chu takes a look at whether market watchers think we could be in for more of the same this summer.
Traders and investors came back from the Memorial Day holiday to a sea of red on Wall Street. Not exactly the way many of the bulls wanted to kick off the summer season for stocks. A big part of the skittishness stems from worries about interest rates. It's widely expected that rates will rise in the coming months, especially after last week when Federal Reserve Chairman Janet Yellen suggested we could see a hike if the economic data improved.
It's very normal in this stage of the cycle when the Fed is about to raise interest rates for markets to become more volatile. So in that respect, we're not at all surprised by this. It's just in a lot of people's view, that was less likely to occur now than closer to September or perhaps even December. But over the last few days, Fed speakers, including Chairwoman Yellen, have made it clear that the first rate hike is going to begin sometime in 2015.
Many market observers do note that while we have seen some more volatility recently, we have yet to see any real stress for stocks or the U.S. economy, at least not enough to cause any real panic. But as markets try and handicap when the Fed will move on rates, more of a roller coaster ride could be in store for the next few months.
I would expect this volatility to absolutely continue through the summer. I mean, you've got a point of decision on whether interest rates are going to be moved up in September by the Fed. They've indicated that September is the likely date. The closer we get to September, the more the market is going to be pricing in the impact, the likelihood and the impact of that move, and that usually creates volatility.
Even though we could see more ups and downs, that's not changing the longer-term investment thesis for some strategists. But it may be a reason to look towards opportunities in certain parts of the market.
We think you should stay the course. You should have a little bit of dry powder on the side. Prudently, I think most people tend to think of things that way. But what we want to do is we want to be buyers of sectors where there's lots of cash on the balance sheet, cash to be used to cushion the volatility, whether it's share buybacks or M&A, and we think healthcare and technology are two sectors like that.
The bigger question is if this leads to a bigger pullback for stocks, something that hasn't happened to a significant degree since the S&P 500's near 10% drop last fall. For Nightly Business Report, I'm Dominic Chu.